Hey everyone, welcome back to Corporate Decoder today. RYET just filed its annual report for the fiscal year ended the 31st of March 2026, and I am seeing a massive shift that you need to understand. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is making a huge pivot, and the numbers from this filing show it is a risky gamble with the future of its business. So this filing from Ruanyun Edai Technology Inc, ticker RYET, is their annual report form 20FEF, and it covers their performance up to the 31st of March 2026. Historically, Ruanyun Edai Technology Inc was all about K-12 education technology in China, think smart exam and smart homework products. But as this report details, they've been making a big strategic shift. They are moving towards a broader AI-enabled education, campus services, and institutional technology platform. This is a big change, and it is really showing up in their financials. Their biggest operational category now is Campuses IAMP Education Services. For the fiscal year 2026 revenue here was $6.99 million, which is a huge 93.4% of their total revenue. But here is the catch. The gross margin on this segment was only 22.7%. That is much lower than what we usually see from software and tech companies. In fact, within this category, Campus Operations 17P Student Life Services alone brought in $5.72 million, making up 76.4% of total revenue, but with an even lower gross margin of 17.9%. This shows they are taking on more operational and service-heavy businesses. On the flip side, their AI Applications DIAMP Enterprise Solutions segment, which includes things like Cogni AI and Yazo, brought in just $0.40 million or 5.3% of their total revenue. While this segment has a much better gross margin of 61.9%, it is still a very small part of their business. Their international education DIAMP testing segment is even smaller, contributing only $0.09 million or 1.2% of total revenue, though it does have a solid gross margin of 52.5%. Overall, total revenues for fiscal year 2026 were $7.48 million, up about 11.9% from $6.69 million in fiscal year 2025. This growth is good, but it comes at a cost. Their cost of revenues jumped by 93.5% from $2.89 million in 2025 to $5.60 million in 2026. This is directly tied to that expansion in their lower margin campus services. As a result, gross profit took a big hit. It dropped by 50.3% from $3.79 million in 2025 down to $1.88 million in 2026. And their consolidated gross margin, it plummeted from 56.7% in 2025 all the way down to 25.2% in 2026. That is a massive compression, primarily because the higher margin AI and international businesses are not yet large enough to offset the lower margins from campus operations. Operating expenses also soared. Total operating expenses more than doubled, increasing by 115.0% to $9.20 million. A big chunk of this increase comes from general and administrative expenses, which shot up by 189.9%. This is largely due to the costs of being a public company after their IPO in April 2025. Including higher legal, audit, and compliance fees. All of this led to a much bigger net loss. For the year ended the 31st of March 2026, they reported a net loss of $7.91 million, a significant jump from a net loss of $0.52 million in the prior year. Now let's look at the cash situation. As of the 31st of March 2026, their cash balance was about $4.08 million. That sounds okay. But remember, their total current liabilities were over $9.11 million. And importantly, their net cash used in operating activities was a staggering $9.15 million for fiscal year 2026. This is way more cash they burned than the net loss they reported, mainly because of a big increase in prepaid expenses, including a $4.2 million prepayment for a research and development project and a $2 million prepayment for international marketing. This is a major red flag for their going concern status. And the auditors are very clear about this. They state there is a material uncertainty related to going concern. They incurred a significant net loss and negative operating cash flow in fiscal year 2026, and their accumulated deficit reached over $23 million. This means they are betting heavily on future financing, including selling up to $100 million in shares over the next 3 years and recent equity financings and loans. But as we know, past performance can be a guide, and relying on future financing is always risky. The company also faces a lot of risks related to its structure in China. They use a variable interest entity or VI structure because of Chinese regulations on foreign investment. This means they don't actually own the assets of their main Chinese operations directly. Instead, they control it through contractual agreements. This vice structure is complex and risky. If Chinese regulators decide these contracts are invalid, or if they change the rules, the company could lose control over its operations, which would be devastating. It is a legal tightrope walk, and if it falls, the value of your shares could be seriously impacted. They even mention in the risk factors that if these contracts are found to be non-compliant, their shares could become worthless. And speaking of risks, they had a data leakage incident in August 2023. While they say the data involved anonymized student learning information, and they paid a fine of about $28,000, it highlights the cybersecurity challenges they face. This is a big concern, especially with AI and campus data involved, where privacy and security are paramount. Looking at the balance sheet, their assets grew to $14.4 million by March 2026, up from $5.9 million in 2025. But their liabilities also grew significantly to over $9.1 million, and their equity is still in deficit. The revenue growth from $6.69 million to $7.48 million is a positive sign, but it is overshadowed by the massive increase in costs and the shift to lower margin business lines. Their stock ticker RYET is trading around $1.04. They did a reverse stock split back in 2022, consolidating 2 shares into 1. This is often a move companies make to avoid getting delisted, but it does not change the underlying fundamentals. The company is making a big bet on expanding into campus services and AI, moving away from their historical education tech roots. While this diversification could pay off, the current financial results show a significant increase in costs and a drop in profitability. The reliance on vice structures in China and the ongoing going concern warnings are major risks to watch. The huge prepayments for R&D and marketing also raise questions about immediate operational needs versus long-term strategy. My biggest concern is the rapid decline in gross margin and the increasing net losses. While the company is trying to build new revenue streams, the current strategy is burning a lot of cash, and it is not clear if these new ventures will become profitable quickly enough to avoid further financial distress. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and check the Discord in the description below.